What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, I want to talk about the differences between saving money in a traditional savings account versus a custom designed dividend paying whole life insurance policy, which in my opinion is a far superior savings vehicle than a traditional savings account will ever be. Now, I'm not saying to not have a savings account or put money in the bank or, put all your money into whole life insurance. Obviously, that's not what I'm saying. I still have money in the bank to cover expenses and stuff like that. But once I understood how these policies work and you can custom design them, it just became a no-brainer to me because the money that I had saved for emergencies and opportunities was just sitting in the bank doing nothing. Why not, if I'm going to save money, why not save it in the most efficient way possible, in the most efficient vehicle possible that gives me the most amount of benefits? A custom designed dividend paying whole life insurance policy absolutely does that. It is just a fantastic savings vehicle because I still have access to my money that I had sitting in the bank account over here. It's a little bit different. We're going to cover that, but I'm getting so many more benefits than just having it sit in the bank. So it just kind of became a no-brainer to me. But if you don't know those options are available, then you can't take advantage of them. So that's what I want to do in this video is just open your eyes to a different way of doing things. Like if you're going to save money, why not save it in the best way possible, right? So let me share my screen. I have a visual here that will break down just going through the main differences. The main first difference is the interest rate that you earn in a savings account, comparing it to a dividend paying whole life insurance policy. Because again, this is dividend paying whole life insurance is comparable to savings vehicles, not investments, not real estate, not stock, not the stock market. Okay, we're talking about a savings vehicle here. All right. Now, historically speaking, savings accounts have paid or offered very low interest rates. Like you don't really put your money in savings or checking accounts or whatever for the interest rates, right? They're pretty good right now, but how long is that going to last? Like historically, they've been very low. So it's not a really good place to grow your money. Plus any gains that you have from that interest, it's taxable each year. With dividend paying whole life insurance policies, custom design, they typically net 3 to 5% tax-free, uninterrupted compound growth for the rest of your life, as long as you have the policy in force. To me, like if somebody told me that there was a savings account down the street at my local bank down the street that was going to pay me, let's just go right in the middle here, 4% tax-free compound growth for the rest of my life, and I could still use the money for emergencies and opportunities without interrupting that compound growth, I'd be like, sign me up all day. That's exactly what this is. That's exactly what we're able to get with a dividend paying whole life insurance policy. You can't get anything close to that with a traditional savings account. And so tax-free compound growth, 3 to 5% to me, that sounds like a really good savings vehicle. Now, one part of one difference, I should say, that might seem like an advantage of savings accounts, I believe is actually a disadvantage when it comes to saving money. And I'll tell you why here in a second. But one potential advantage you could say that a savings account has over whole life insurance is that there's easy access to the money. You typically get an ATM card. You can write checks on it. There's also typically no cost, at least that I'm aware of anyways. I guess it depends on the bank and the account you set up, but there's no cost to access that money. So if an emergency or an opportunity comes up, you can access that money like that day, right? I would actually challenge that to say it's a disadvantage, really depending on what you're using it for. But if you have really easy access to your safe money, to your savings, that makes it easier for you to spend it when you probably shouldn't be spending it, right? So with a dividend paying whole life insurance policy, we can access our money. It's called cash value. Okay, that's basically the equity. Cash value is the equity we have in our life insurance policy. Very similar to if you own a home, you have equity in it, you can get a home equity line of credit and access that money to spend it on whatever you want. Cash value operates pretty much the same way in a whole life insurance policy. So we can access our cash value and we can custom design our policies to have access to the money we put in the first year to have 90% access to that money, or access to 85 to 90% of it within the first 30 days. So it's a small hit in the beginning because we are buying life insurance. It's not like we're just taking a hit. We're actually buying something here. We get a massive death benefit, gets passed on to our loved ones if something happens to us. But it's a small price to pay to set this up because again, we're going to get that 3 to 5% tax-free compound growth for the remainder of the policy, plus all the other benefits. And literally all I have to do to access the cash value of my policy is log into my online portal, tell them how much I need, and it's in my account in 2 to 3 business days. Doesn't take very long. All right. But again, I challenge this particular advantage, like easy access. Well, this kind of forces you to save a little bit better, be more responsible with it, because you have to wait a couple of days to actually access the money. I think that could actually be beneficial. Plus, there's interest costs associated with accessing the money because we're typically taking a policy loan. Now, on the surface, that might sound like a bad thing. I would challenge that it's not. I would push back against that and say that it's not, because if there's an interest cost associated with you using your safe money, then you're less likely to access that money if it's not a real emergency, right? It makes you think twice before you access your safe money. Now, the other part of that is like if you're taking advantage of opportunities, that's how I'm using my policy right now. I put 120K in the first year. I had access to about 103,000 within the first 30 days. Actually, it's the first couple of weeks. And that number is only going to grow, for like each year that I have the policy. But with policy loans, there's interest costs, and like I use my policy to build wealth and take advantage of opportunities. But I've done training on the difference between compound interest, simple interest, amortized interest, whatever, and why it absolutely makes sense to pay a little bit of interest to have this set up here while still being able to use that money to build wealth, et cetera. It's a small, very, very small price to pay to get all of the benefits that we get with these policies. So I'll link that down below if you want to check that out and learn more. But I think this is actually an advantage of whole life insurance being making it a far superior savings vehicle, because you're less likely to access the money for things that might not actually be an emergency. So I think that's good. There's with savings accounts, there's lost opportunity cost to use the money. With dividend paying whole life insurance, it's not. Here's why. So what happens when, let me just go back full screen here for a minute. What happens when you take the money out of your savings account, use it for an emergency or an opportunity? Well, that money is no longer earning interest for you. It's gone forever, right? There's a massive opportunity cost to that. So for example, let me pull up a compound interest calculator here. I want to share this with you guys. Just so you can see the impact of lost opportunity cost. So the example I always give is $28,000 that I paid for my vehicle. Okay, but before, like, I didn't take the $28,000 out of my account and pay for the car with cash. First, I put the money in my policy, and then I took a loan against it to pay for the vehicle. This is why. Because if I had just paid $28,000 from my savings account, for example, all right, and we're getting that net 3 to 5% tax-free compound growth in our policy. So I'm just going to say 4% here, right in the middle. This is what the car would have actually cost me. This is lost opportunity cost right here, because that $28,000 would no longer be available, would never earn another dollar of interest for me ever again. Like, so the car didn't actually cost me $28,000. It cost me $134,000. This is just over 40 years. So when you start to see numbers like this, and you realize that there is a way to avoid this lost opportunity cost with a dividend-paying whole life insurance policy, now all of a sudden these things start to make a lot more sense. With whole life insurance, because I took a policy loan, like I borrowed against my cash value, the $28,000 I used to purchase my vehicle is still in my policy, getting that uninterrupted tax-free compound growth. The only cost for that is the interest. And you know what my the interest rate is on my policy loan? It's 5.5%. That's way better than I've heard a lot of people getting on their car loans these days. I talked to somebody earlier who has an 8% interest rate on his vehicle, and he has good credit. So the interest rate is actually a lot better. So there's that benefit. But the main benefit I'm trying to make you guys aware of is that because we are borrowing against our policy and not actually using our own money, we're using the life insurance company's money, we are eliminating those lost opportunity costs. And the only price to pay for that is that little bit of interest that we pay on the policy loan. So this to me was a huge, huge advantage of saving money in a whole life insurance policy versus savings accounts, because I can still access the money, but I'm not interrupting that compound growth. So I'm able to buy whatever it is that I need or cover whatever emergency that it is without that lost opportunity cost. I think that's huge. With savings accounts, there's no living or death benefits. We're buying life insurance here with whole life insurance. Obviously, there are living and death benefits. What this means, and typically what I'll ask people is the money you have in your savings account, if something were to happen to you right now or tomorrow, would your savings account blossom, like the money that you have in there, let's say it's $50,000, would that money blossom into a massive income tax-free death benefit that avoids probate that would go directly to your beneficiaries, your loved ones, your family, whoever? No, savings accounts don't do that. You could pass on your savings accounts to your loved ones, a specific beneficiary. You could do that. It's probably going to get locked in probate like it does a lot of times. It's going to get taxed as well. It's also not going to blossom into a huge death benefit. We're talking about, and it depends on how old the policy is. But, if you have $50,000 in a savings account and, instead you move it into a life insurance policy with a $2 million death benefit, we use mine as an example, then I would say that's a pretty good benefit. In case something were to happen to me, my loved ones would be taken care of. Also with living benefits, if you were to get diagnosed with a chronic, critical, terminal illness, something were to happen to you, you can't perform 2 of the daily activities of living all of a sudden, would your savings account blossom into, again, a massive benefit that you could use for whatever care that you want to get beyond what health insurance won't cover or whatever? Right. So these are additional benefits that we get from saving our money in a whole life insurance policy versus savings account. It just doesn't do that. The other thing too is like this was a pretty big eye opener for me when I started going down this rabbit hole. Is banks are not as safe as we think. Like again, we're taught that and just kind of assume that when we want to save money, we put it in the bank. That's the safest place to put our money. It's like when you actually do your research and look at the history of banks, it's not. They don't have a really good resume. They don't have a really good track record of success and safety. Like how many banks failed during the Great Depression, the financial crisis, savings and loan crisis, 2008, .com bubble, right? Like banks have a pretty shady history, and you could argue, yeah, but I have FDIC insurance, and which I think is just a joke. It doesn't have anywhere near enough money to cover all of its obligations. So like, if that's what you're relying on, I don't know. For me, that just doesn't help me sleep at night because also, how long would you have to wait in order to get access to your money? Not to mention potential bail-ins now, like the next banking crisis. How are they going to handle that? Are they going to print money? Are they going to bail the banks out? Are they going to bail in, meaning they're going to take customer deposits? They can absolutely do that. That was part of the 2008 Dodd-Frank Act. Banks are able to literally take our money from our account, issue stock or whatever in a failing institution now in exchange for that. Like, it's just crazy. And for me, I'm not okay with that. Like I've worked too hard for my money to put it at risk like that. And I sleep so much better at night knowing that my money is with extremely safe companies here. Like these mutually owned life insurance companies are some of the best, just most financially sound, best risk management companies in the world. While banks have been failing throughout the last 150 years, mutually owned life insurance companies have actually paid dividends to their policyholders. Many of them have never missed a dividend payment for over 150 years. That is crazy to me. That means during the Great Depression, these companies were actually paying out dividends to their policyholders. Like, that's just crazy to me. So from a safety perspective, okay, do I want my money in a bank, like a large amount of money in the bank, or do I want it with a company that has paid dividends throughout the worst financial crises over the last 150 years and continue to do so? Like that, to me, again, it was a no-brainer. When I did my research, I looked at the history of banks and these mutually owned life insurance companies. You look at just how financially sound they are. They're also not exposed to the fractional reserve banking system that banks are, where you can get runs on the bank and all that. You can't get a run on a life insurance company. It's just, unless we're talking about something like a mass casualty event, which is the life insurance company going under is going to be the least of our concerns, right? But that's like a really extreme example. I don't see a safer place to put my hard-earned money than a mutually owned life insurance company. You just can't beat them. So anyways, those are the main differences, guys, that I wanted to talk about and share with you. They were some pretty big, just kind of light bulb moments for me, I guess, when I was going down this rabbit hole and just learning about how these things actually work. I just was like, wow, there's just so many more benefits to saving money here because, I get all these benefits here. I'm going to get this uninterrupted tax-free compound growth. I can still access my money for emergencies and opportunities. Why on earth would I not do this, right? So it just made sense to me. But anyways, if you guys have questions about this, then please drop some comments down below. If you, I'd also love to hear your feedback. If you'd like to also have a conversation about this to just see if a whole life insurance policy might make sense for you, I will have links in the description. You could book a call with either myself or my team, and we're happy to walk you through the process, answer your questions, learn a little bit more about your situation, see if it makes sense for you. All right. So either way, I hope you guys are crushing it, doing well, and I will talk to you in the next one. To your success. Matty Ice is out.